All right, so, like, who doesn't dream of uncovering those stocks ready to skyrocket, right?
Right. That's what we're diving into today. We're taking a deep dive into this prediction from the Motley Fool.
Okay.
You know them, those finance wizards always aiming to make us, well, their words, smarter, happier, and richer.
Yeah.
And hey, we all love the stability of index funds, but let's be honest, finding those individual stocks ready to take off, that's exciting.
Oh, absolutely. It's the thrill of uncovering hidden potential, being ahead of the game. That's what makes this so interesting.
Exactly. So we're breaking down the Motley Fool's picks, not just seeing what they chose, but understanding the why, giving you the insights to make sense of it all. Ready?
Let's do it. Okay, they kick things off with two names that practically scream tech titans. Amazon and Microsoft, both part of the elite Magnificent Seven. But what makes this group so magnificent, especially for investors like you?
Well, Magnificent Seven isn't just a fancy title. It represents companies with incredible power, not just in their industries, but on the entire market. How they perform often indicates how the whole economy is doing. When these giants make a move, everyone pays attention.
Makes sense. Now, think Amazon, you think online shopping, right?
Right.
But here's the thing. The Motley Fool is highlighting something entirely different. Amazon Web Services, or AWS. That's Amazon's cloud computing arm. And it's not just some side project.
Definitely not. People often focus on Amazon's retail side, but AWS is becoming the internet's backbone. All that data generated every second, every website, every app, AWS provides the infrastructure. Their growth in this area is astounding.
Yeah, we're talking 10% revenue growth for Amazon overall, which is impressive on its own, but a massive 75% growth in operating cash flow. AWS is a huge driver of that. And this is where it gets really interesting. Their price-to-earnings ratio, or PE ratio, is currently at 32. Now, their 5-year average is 54. Just so everyone knows, the PE ratio basically shows how much investors are willing to pay for each dollar of a company's earnings. A lower PE than their average could mean the market's undervaluing their potential, which caught my eye.
It's a great point, and it's more than past performance. Amazon is strategically setting themselves up for the future. The article emphasizes their heavy investment in artificial intelligence as a major growth factor. This forward-thinking strategy is vital in a world becoming more and more reliant on AI.
And speaking of AI, let's talk about Microsoft. They're everywhere. Software, gaming, cloud computing, you name it. What struck me was their bold move to invest billions in OpenAI, the geniuses behind ChatGPT. That's a powerful statement about the future of AI.
Absolutely, and it goes beyond just money. It's about integrating AI into everything Microsoft does. Think about AI smoothly embedded in everyday tools like Office, Azure, even Xbox. Microsoft's crafting a more connected and intelligent experience for everyone.
It's like they're weaving AI into the DNA of their products. Pretty smart move, if you ask me. And their PE ratio, a respectable 33, basically on par with their 5-year average. So maybe not undervalued like Amazon, but definitely showing potential for solid growth.
It shows how much faith investors have in Microsoft's ability to change and innovate. But let's shift gears away from these tech giants for a bit.
Okay.
And look at a company that's been quietly making a comeback. PayPal.
PayPal. The pioneer of online payments, right? They've been a little quiet lately, but the Motley Fool seems to think they're about to make a big splash. What's behind this resurgence?
Well, what I find really interesting about PayPal is their ability to bounce back. They faced their share of obstacles, but now, with new leadership, a strong balance sheet, and a bunch of innovative features, they're in a good position for a comeback.
And they've definitely got the user base for it. 426 million active accounts, processing something like 25 billion transactions every year. That's incredible.
Those are some serious numbers.
Yeah. So what about their recent performance?
Their recent financials are promising. They've seen 8% revenue growth and, get this, an 11% jump in payment volume.
Wow.
Which tells us they're not just keeping their existing users, but attracting new ones too. And, importantly, those users are becoming more active on the platform.
It's interesting how their comeback lines up with the whole fintech boom that's happening. We're seeing a major change in how people manage their money, and PayPal seems to be right there riding that wave.
Exactly. And it highlights why it's important to look beyond the big names everyone knows. Sometimes the most exciting opportunities are in those companies that are going through a strategic shift or reinventing themselves.
I like that.
Yeah.
Okay, so we've gone from a fintech giant to a company you might not be as familiar with, Veeva Systems. They're all about cloud-based solutions, but here's the interesting part. They focus specifically on the life sciences industry. What's their deal?
Veeva is a great example of a company strategically carving out their own space in a rapidly growing industry.
Okay.
Their cloud platform is essential for pharmaceutical companies,
Mhm.
especially when it comes to managing clinical trials.
Yeah.
It's a complex process, highly regulated, and Veeva's platform helps streamline it.
And their client list is impressive.
Oh, absolutely. You're talking big names like Moderna, Eli Lilly.
Wow.
The list goes on.
So they're not just surviving in that world, they're thriving. Their last quarterly report showed a 15% jump in revenue. And even more impressive, subscription revenue was up by a whopping 19%.
And that's the beauty of the subscription model. Recurring revenue offers a level of predictability and stability that investors love.
Makes sense.
It allows for more strategic planning and sustainable growth.
And to top it off, Veeva has a rock-solid financial position, billions in cash reserves, and zero debt. Not many companies can say that. And their PE ratio, a very attractive 34, especially when you compare it to their 5-year average of 50.
Veeva is a perfect example of why it's crucial to look beyond the obvious choices. They've made themselves indispensable partners in a high-stakes, high-growth industry, and their financial performance really reflect that.
It's like finding that hidden gem, that diamond in the rough. Okay, so for our last pick, we're switching gears again. This time, it's not a single company, but a way to tap into a whole industry that's fundamental to so much of the technology we use today: semiconductors. The Motley Fool is highlighting the iShares Semiconductor ETF.
Right, so ETFs, or exchange-traded funds, are a fantastic tool for investors who want to diversify their investments within a specific sector. Instead of putting all your eggs in one basket with a single company, you're spreading your risk across multiple stocks.
Okay.
In this case, it's 30 companies, all involved in the semiconductor industry.
And you really can't overstate how crucial semiconductors are. They're the brains behind everything: our smartphones, laptops, cars, everything. And as we move towards a future driven by AI, data centers, and all these interconnected devices, the demand for semiconductors is only going to explode.
Exactly. And this ETF puts you right in the driver's seat of that growth story. It includes some of the biggest players in the industry: NVIDIA, Broadcom, Qualcomm companies that are leading the charge in semiconductor innovation.
It's like having a slice of the action in the whole tech revolution.
Exactly. That's the strategic advantage of going with an ETF. You're not trying to guess which single company is going to come out on top in such a fast-changing field. You're investing in the overall trend itself.
That's a really good point. So we've covered a lot of ground today. We talked about AI powerhouses like Amazon and Microsoft, the quiet comeback of PayPal, Veeva Systems carving out their niche, and the strategic play of the iShares Semiconductor ETF. That's quite a lineup.
Definitely. And the common thread running through all of these picks is their link to these strong long-term trends that are shaping the future. We're talking about AI's continued rise, the unstoppable demand for cloud computing, fintech's resurgence, and the ever-growing need for semiconductors. These aren't just temporary things. They're forces that are completely changing the world as we know it.
And that's where smart investing comes in. We've gone behind the scenes, looked at the why behind these predictions, but, and this is important, past performance doesn't guarantee future results. Before you make any investment decisions, do your homework, know how much risk you're comfortable with, and as always, invest wisely.
Couldn't agree more. And one last thing to think about. This article we looked at today focused on companies in the U.S., but innovation's happening globally. As you continue exploring investment opportunities, think about this. What's going on in other parts of the world? Which global players are ready to take advantage of these game-changing trends? That's the exciting part of this journey. It's about staying curious and enjoying the thrill of discovering something new. Good luck with your investing, everyone.